Why don't more financial advisors use derivatives to manage money? So let me address that, because I get that all the time. And Dom, if you're right, why aren't more people doing it? Well, first of all, the average financial advisor lives in this world of diversifying your portfolio. Don't put all your eggs in one basket. Oh, makes sense. But yet the most popular mix in financial money management is down 15% this year. So how good has that worked for you lately? Okay, number two, advisors are not money managers. People don't know that. Merrill Lynch, Edward Jones, third floor. Financial advisors aren't money managers, but money managers are financial advisors. I was a financial advisor for 15 years. Yes, I've been a money manager for the last 15, 20 years. So that's the problem. Advisors are told what to recommend, just like I was when I was on Wall Street. Advisors have very little knowledge of options. It's groupthink, what is being recommended, and that's the problem. And they're using strategies that was developed by Dr. Markowitz and Dr. Sharp in 1952 called modern portfolio theory. It's very profitable to sell investments, and that's sort of the groupthink that's going on. But the bottom line is advisors are really good at golf because they have time to play golf. I don't have time to play golf. That's why my golf score is terrible, because I'm managing these brilliant kids and my quants to try to really build portfolios that work. So that's number one. And I will tell you this, and I will say this with confidence, that I'll put these three young people on optionality against any professional that's been in this business at least 10 years that works for Wells Fargo or works for Edward Jones or works for Raymond James or works for Merrill Lynch, because they understand how to use options in a very sensible way. These advisors don't. If your advisors are recommending some type of diversity, this article says run, time to ditch the 60-40, but Vanguard is still pushing it. They still defend the 60-40, but Vanguard wants you to buy their funds and buy their ETFs. The long bond's down 20% this year. And if you believe interest rates are going higher, if you believe the Fed's going to keep pushing his pedal, then the long bond's going to keep going down. So are you telling me that I should have you guys that are in your mid-80s in 85% bonds? No. But that's what the Certified Financial Planning Association tells me to do, because I've got that certificate on my wall. And that means I'm an expert. Using options is being used at the very, very private wealth level. In other words, when I go to these conferences in Chicago, these derivatives, these conferences that just specialize in these tools, guess who's in the audience? Private wealth manager at Goldman Sachs, at JP Morgan. Yeah, if you guys are a $20 million client, guess what they're using? But at this level, at what I do for you guys at this level, at the retail level, no. Here, just buy this Merrill Lynch growth fund, and then buy Merrill Lynch bond fund. And so it is, the growth has exploded. And that's why I tell my interns, you want to make a six-figure salary? Learn two things, how to program and learn derivatives. Because that's what the big firms want. They're looking for people that can help these pensions and endowments manage money the way it should be managed. So I'm not outside the box when it comes to the professional side of the business or the true big money business. I'm outside the box when it comes to sort of the retail level. And then number three, it's hard. It's hard. Jeff, what we do is hard. Is it hard?
It's hard.
Is it hard? Is it hard? It's hard. And let me explain why it's hard. Does anybody in here hike? Used to hike? Okay. We like to hike. Maybe you hiked. Jeff, are you up there in Grinnell Pass? No, okay. If you get confused, I guarantee you will. Don't worry about it. I just want you to understand the conclusion. Let's assume this is Grinnell Pass. So let's assume I know where the valley is and I know where the pass is. And so think about when I'm looking at options to manage risk. I'm looking this is called where options are expensive, which would be this is the price where you strike the option. This is how long the option is, how many days till the option expires, and this is how expensive an option is. So maybe I want to sell the peak and buy the valley. I want to create an edge. So my hedge gives me a good edge and low cost. And everything's fine. And then all of a sudden I come back a month later, Jeff, you come back to Grinnell Pass and all of a sudden it looks different. And you go, well, wait a minute, the mountain was over here, now I got a mountain and a valley over there. So that's exactly the problem with using options is you've got to change your positioning of your options as this topo map changes. We call this the volatility surface. So I can't just set it and forget it and get my golf score down to 0. I've got to, my engineers, my quants have to look at the vol surface and adjust to that vol surface. And as the vol surface, as the topo map changes, where and how the options are placed have to be repositioned. So you could say to me, Pia, you could say to me, Dom, could you explain where you have my money invested? Well, a year ago, how I had your hedges is very different than where it is today. And it was very different 2 years ago. And it might be very different in 6 months. So what makes me change is how the weather changes. So think about it this way. When it's wintertime, we wear coats. When it's summer, we wear flip-flops. So that's why it's hard. As the environment changes, the volatility surge changes, the portfolio needs to be re-optimized and repositioned.